risk inherent in China. In an exclusive interview, the Muddy Waters chief also weighed in on the rise of the retail trader.
When you have passive buyers of more and more of the float, it doesn't create a linear upward effect on stock prices. It creates a convex upward impact on stock prices. So then you layer on top of that retail buying of out-of-the-money calls to create these gamma squeezes, and so you just get this crazy disconnect in a number of stocks between the actual economic fundamentals and what the stock prices are doing. Now, the saving grace for people such as myself, that when it comes to meme stocks, they advertise it openly that they're going to squeeze it. So we're no longer ignoring that, or we're very attuned to where retail traders are talking these things up. So we don't have so much capital that we can't get out of the way, knock wood. So I'm not so much worried about that, but it's the distortion of passive buying on really just a lot of crap companies and sometimes abject frauds, especially from China, that to me, that's the more disturbing issue.
Well, but how do you then engage with this? How do you make money? Do you stay away altogether? Or when you said that, basically they're advertising what they're going to do, and then you can play with that, how?
Well, so we're not playing long squeezes on meme stocks, but a good example of how we utilize this was XL Fleet. That's a company that we shorted earlier this year. It's a SPAC. It's, close to an empty box, basically, in our view. And the stock had gone down and we made money on it. Now, we're very quick to pull the trigger on getting out of something if we have to. So we saw all of a sudden retail traders talking it up. There was a bunch of buying of out-of-the-money call options, and we just covered our short entirely. Turns out the stock did not squeeze, but better safe than sorry. So that's how we're utilizing it. On top of that, we run our book generally market neutral. So for every dollar short a name, we're going long to hedge it. And we're going long rather than just indices. We're going long what are called factors or factor baskets. So for every short position, we might have 30 to 50 tiny long positions that we think will explain most of the beta there. So that's how we've changed our business to keep up with the times.
In the meantime, there's also this concern. You could have meme traders in the United States, and over in China, you could have massive policy shifts that suddenly start to change entire industries. We saw that with the semiconductors today, as people were concerned about potential accusations of price manipulation from regulators in China. You've also seen this with milk formula and other areas. How do you get a sense of what the next area they might be targeting could be? Do you try to play in any of that, or does that make it nearly uninvestable for you? Because it's not about fundamental research. It's based on something that cannot be predicted.
Well, that's the point. It can't be predicted. And I think that investors for the past decade were basically pulling the wool over their own eyes on the capriciousness of the policy environment in China. So that's coming home now to bite a number of investors. But it's just one of many risks that you really need to take into account, but investors have not. And it's another reason why, all other things being equal, a China stock should trade at a significant discount relative to a stock that's from a company that's based in the US. But often we found that they don't, because investors like to tell themselves these fairy tales about there's this tremendous cognitive dissonance, always has been with China. Investors will say, well, it's growing really quickly. We think that the real GDP growth print will be 7% this year. And I'd say, but that's not real data. That there's inaccuracy and then lying embedded in that, and nobody actually takes that seriously.
Carson Block there of Muddy Waters in an exclusive conversation with Bloomberg's Lisa Abramo.